Hi, I'm Matt, advisor here with Networth Advisors.
And I'm Ayden, advisor at Networth Advisors.
You know, people spend their whole working lives saving for retirement, but when it's finally time to turn that nest egg into income, it's not always clear exactly how to do that.
Exactly, and the approach you take really matters. The right withdrawal strategy can help you stretch your savings, while the wrong one could mean paying thousands more in taxes than you have.
And that's why we work with our clients to build retirement income plans that are steady, but more importantly, tax efficient.
So before we dive into withdrawal strategies, let's set the stage with something we call the 3 tax buckets.
That first tax bucket we like to talk about are those tax-deferred accounts. Think of these things like 401ks and those traditional IRAs.
Then you've got your tax-free bucket, which includes Roth IRAs and Roth 401ks.
And finally is that taxable bucket. Things outside those IRAs like brokerage accounts.
Understanding these buckets is key because when and how you pull money from each one has a huge impact on your overall tax bill.
So now let's talk strategy. One of the more common approaches that we see is giving your tax-advantaged accounts time to grow.
That's the strategy where you start retirement by tapping into your taxable brokerage accounts. You only pay capital gains taxes on profits, and meanwhile, your other accounts keep growing tax-free or tax-deferred.
After that, you move on to your tax-deferred accounts, those traditional IRAs and 401ks. Those withdrawals are taxed like income, but waiting let your Roth accounts grow and continue to appreciate.
And finally, when you've worked through those, you turn to your Roth accounts, which are tax-free.
Now, the conventional strategy works well with a lot of people, but it does have one big drawback. Once you finish those taxable accounts and move on to those tax-deferred ones, your tax bill can jump pretty abruptly.
That's right, Matt. And that's where the proportional withdrawal strategy comes in. Instead of using up one bucket at a time, you pull from all 3 buckets at once in proportion to how much you have in each.
If you got 40% of your money in those taxable accounts, 30% in those tax-deferred, and 30% in those tax-free, each withdrawal you make follows the exact same ratio.
That way, your tax liability is spread out more evenly over time.
Now, at the end of the day, there's countless retirement income strategies. But determine the best one for you comes down to looking at your unique situation.
And that's where we come in. At Networth Advisors, we help you create a plan that's built for your goals and the future that you want.
So if you're ready to talk through what those options are, give us a call at 724-746-3585 or email us at schedule@networthadvisorsllc.com.
Thanks for watching.